Is the India First Life Wealth Maximiser plan your gateway to long-term wealth or just another market-linked gamble? Let us find out through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand a few basic details about it. This is a unit-linked, non-participating individual savings life insurance plan. Some of the key features of the policy are: it is customizable to your needs, where you can choose your policy term and premium payment option that aligns with your financial goals. You get to pick from 7 fund options and 3 investment strategies to match your risk appetite and return expectations. And you also get to enjoy additional benefits like loyalty benefits, profit booster, and loyalty advantage for staying invested longer. And you get to make unlimited free switches or redirect your premiums to optimize your returns. And also there are tax benefits on the premiums you have paid and also the benefits you have received, which may qualify for tax deductions or exemptions as per the prevailing tax laws. So these are some of the key features of the policy, and there are other benefits as well, like maturity benefit and death benefit. So these are some of the benefits, but as a unit linked policy there are also several charges like premium allocation charges, policy administration charges, fund management charges, mortality charges. Like this, there are several charges. While the plan imposes fewer charges compared to many other ULIPs, there are still certain charges that continues throughout the policy term. So over time, these recurring deductions can reduce your investment value and long-term returns. So these are some charges that you need to keep in your mind as a drawback before deciding to invest in this policy. So now let us take a look at the advantages. So you can add riders to the base policy for additional protection. You also get to choose to receive your maturity benefit either as a lump sum or in installments, and you also get to make partial withdrawals or opt for systematic partial withdrawals after the 5th policy year, and you also get to move between funds anytime without incurring charges, and from the 2nd policy year onwards you can redirect future premiums to different funds based on your evolving needs. So these are some of the advantages of investing in this policy. However, the disadvantages are this plan comes with a 5-year lock-in period restricting yearly access to funds. Only the net premium after deducting charges is actually invested. The sum assured may be insufficient to provide adequate financial protection. The risk-return trade-off is not favorable, making it less efficient as an investment tool. The loan facility is not available under this plan, limiting liquidity in times of need. So these are some of the disadvantages that you need to keep in your mind before deciding to invest in this policy. So now, as we have a basic understanding about this policy, let us move on to the analysis part of the video, where we are going to analyze the internal rate of return of this policy by conducting an IRR analysis based on the benefit illustration given in the policy brochure. So here, for calculation purpose, we are going to assume that a 35-year-old male opts for this policy with a sum assured of 62,50,000 with an annual premium of 2,50,000 with a policy term of 40 years and a premium paying term of 10 years. So here in this example scenario, we have projected 2 rates of return, which are assumed returns of 4% per annum and 8% per annum as given in the policy brochure. Just for example purpose, these are not guaranteed and they do not reflect the actual performance of these funds, which may vary based on market conditions and investment decisions. So as given in the projected in the tabular column, you can see that the maturity benefit at the end of 40 years at 4% assumed return is 47.23 lakhs, which gives you an IRR of 1.80% as per the policy's maturity calculator. At 8% assumed return, the maturity benefit is 2.49 crores, which gives you an IRR of 6.64% as per the policy's maturity calculator. However, even at the higher assumed rate, the returns are not proportionate to the market linked risk. In fact, the IRR under this plan is lower than what traditional debt instruments can potentially offer, but with higher risk and a long long-term lock-in period. So this undermines the very purpose of choosing a market-linked product, which is to generate better inflation-beating rents and may slow down your wealth-building journey or result in a shortfall when you need it the most. So now, as we have a basic understanding about this policy is not giving us a desirable outcome that we need, let us now move on to a comparative analysis where we are going to look at a smarter alternative strategy by separating insurance and investment using the same 2,50,000 annual premium from an earlier example. So here for life cover purpose, we have opted for a pure term life insurance policy offering a sum assured of 1 crore, which is comparable to the Wealth Maximiser plan, and it costs around 30,500 rupees per year for a 35-year-old with a 40-year policy term and a 10-year premium payment period. That leaves us with 2,19,500 rupees annually available for investment. So here, if the investor prefers a low risk option, they can invest 1.5 lakh annually in a public provident fund PPF for 15 years, which you can adjusted here slightly for the regulatory cap for example purpose. So over 40 years, this investment has grown to approximately 2.55 crores, yielding an IRR of 6.71%. Despite being a debt instrument, PPF outperforms this policy even under its best case 8% projection. For those with a higher risk appetite, investing 2,19,500 rupees annually in equity mutual funds through SIPs over 40 years can generate a corpus of 12.92 crores. After factoring in long-term capital gains tax, the post-tax value comes to around 11.33 crores, translating to a post-tax IRR of approximately 11.20%. So the strategy shows us clearly that combining insurance and investment in one plan is inefficient. By separating the two, you gain higher returns, better liquidity, and greater flexibility. And if you have any doubts regarding how we have calculated the tax for equity mutual fund, we do have a small tabular column presented on the screen for your easy reference, which you can pause and see. So these essential benefits are missing in the IndiaFirst policy, making it a less than ideal option for long-term wealth creation. So what is the final verdict then? Is investing in the IndiaFirst Life Wealth Maximiser plan worth it or not? So here you pay premiums either for a limited period or throughout the policy term. However, only a portion of the premium gets invested, and that too after deducting multiple charges. At maturity, you receive the fund value, but the returns often fall short of market expectations. Given the risk involved, these returns are simply not justifiable. One of the main reasons for this underperformance is the high charges, which erode your investment value over time, coupled with an inadequate life cover and a lack of liquidity as your funds remain locked for the long-term period. This plan does little to support your overall wealth building journey. So overall, poor returns, long-term lock-in period, and insufficient insurance coverage makes this plan unsuitable for your financial portfolio, and it also has a high agent commission. So the core issue lies in combining insurance and investment into one product, which results in compromising on both. A better approach is to opt for a pure term life insurance plan to secure your family's future at a low cost and invest the remaining funds in a diversified portfolio tailored to your goals.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.